Welcome to our deep dive into the key measures of the 2026-27 Australian federal budget. This budget introduces significant structural changes. This year's budget focuses on long-term fiscal repair, featuring major tax reforms and substantial savings measures. The overall fiscal position shows an underlying cash deficit of $28.3 billion, or 1% of GDP, in financial year 2026. This is an $8.5 billion improvement, driven by higher commodity prices boosting corporate tax revenues. However, the deficit is projected to widen to $34.4 billion in financial year 2027, as rising energy prices and interest rates are expected to weigh heavily on growth in government revenues. A significant part of this budget involves major tax reforms aimed at fairness and long-term stability. From July 1st, 2027, the existing 50% capital gains tax discount is replaced with cost-based indexation. A 30% minimum tax on net capital gains is also introduced. This is projected to save $3.5 billion over 5 years. The budget directly addresses negative gearing alongside CGT reforms. Existing property holdings are grandfathered, ensuring a gradual impact while supporting 75,000 more Australians to buy homes over the next decade. A 30% minimum tax rate is introduced on the taxable income of discretionary trusts. This measure saves $4.4 billion over 5 years and aims to close a long-standing loophole used for income splitting. The budget also includes targeted concessions to support small businesses, startups, and working Australians. The $20,000 instant asset write-off for small businesses is made permanent, significantly reducing compliance burden. Loss carryback provisions and extended loss refundability are also introduced for startups. A permanent $250 working Australians tax offset will be effective from 2028, which effectively raises the tax-free threshold by almost $1,800 for workers and sole traders. One of the most significant elements of this budget involves major reforms to the National Disability Insurance Scheme, or NDIS. The NDIS reform package is one of the largest spending saves since the mid-1990s, projecting to reduce scheme growth by $37.8 billion over 4 years, starting from financial year 2027. These structural changes involve a rapid slowdown in cost growth and the planned removal of 160,000 existing participants from the scheme. By financial year 2037, NDIS savings alone are projected to improve the budget bottom line by approximately 0.7% of GDP. It is important to understand that the impact of these major savings is heavily backloaded, presenting a key caveat for the medium-term budget outlook. The full impact of the 1% of GDP budget improvement isn't reached until around financial year 2037. In the budget year of 2027, savings amount to only 0.1% of GDP. In the near term, discretionary measures actually add $14.2 billion to the fiscal impulse over financial years 2026 to 2028, meaning policy remains slightly expansionary in the short term. The success of the budget's savings agenda hinges significantly on smooth political execution, which faces notable risks. Westpac flags execution risk as key. The Greens oppose NDIS changes, and the Coalition opposes the housing tax reforms and the discretionary trust minimum tax, threatening legislative delays. Any political delays or dilution of these measures could significantly undermine the medium-term budget improvement story that this budget promises.